for taking the time out and being here. I'll be talking about investor behavior. So my talk will be relevant only to probably a portion of your financial well-being. There will be a talk on financial planning and tax planning later on. So financial planning is probably the first step that any individual or a family needs to go through. And once that is there, once you are clear on what is the risk appetite, what are the financial goals, what is the current position, what is the asset allocation, meaning how much money you want to put in equity, how much in fixed income, how much in real estate, how much in gold, what kind of risk covers do you need, all of that. Then you come to the investing part. So what I'll talk about is the investing part, and rather than talk about economic outlook, sectors, techniques on how to identify stocks, I'll look at our own investor behavior or our own behavior as it pertains to investments. A lot of people start scratching their head when I talk about behavioral finance. So what is behavior got anything to do with finance? Typically, whenever people think about finance, people think about mathematics, people think about numbers. For those of you who invest in, let's say, equity markets, or who have ever read any equity research report, they'll find that people writing those reports will say current share price is 85.65 and our target price is 136.75, or our DCF value is something. That people will be precise to the second decimal point. People will scratch their heads, or people will quibble about whether fiscal deficit will be 3.2 or 3.3 or 3.4, and what is the current account deficit, or what is inflation. So what has behavior got anything to do with it? In fact, most of what finance is, we have learnt in high school. Anyone recognize what this formula is? Compound interest formula, right? Amount after a certain number of periods, typically years, is principal multiplied by 1 plus rate of return expressed in decimal points raised to the power of n, n being the number of periods for which you are investing. So typically that should be what finance is. You decide how much you are going to save for what period and what is the return you are going to get, and you know how much you will get at the end of that period. And this works very well for your home loans, car loans, for your bank fixed deposits. So it works very beautifully for all of these things, plus even loans, home loans as I mentioned, as long as the interest rate is fixed, as long as the interest rate is not a floating rate interest. In which case we can tear up the behavioral aspect, tear up my entire talk and just stick with the formula that I presented in the earlier slide. Where behavior comes into picture is whenever one moves beyond the well-defined aspect of the financial markets. So what I'm going to talk about is relevant for things like equity investing, things like real estate investing, maybe investing in corporate bonds. I was sitting here and the gentleman behind me asked about Bitcoin. Now I don't know much about Bitcoin, and I don't know whether it qualifies as an investment in the first place or it qualifies as a trading or a speculative asset. But what I do know is that behavioral aspects definitely come into play even there. These things cannot be put in a neat formula. So I've just put a share price graph on the screen. This is the 1-year share price graph of a company called Interglobe Aviation, popularly known as Indigo. This is the company which runs the Indigo airline. Now, the talk has nothing to do with Indigo or the aviation industry. It's just for illustrative purposes. Just look at the ups and downs of the share price. So, it peaked at somewhere around 1500 plus or whatever was the peak, and it fell to somewhere about 650, 700, and then again bounced back to 1200, 1300. So this is within a span of 1 year. So something which people thought is worth 1500, in just a few months they thought it's worth 650, and then again they thought it's worth 1200. So why is that? Why does that happen when it comes to investing? And why does that happen with real estate? At one point, maybe everyone was rushing to buy apartments in Noida or in Gurgaon, and suddenly people don't want those apartments anymore, or suddenly everyone wanted bitcoins, and now no one wants bitcoins. So why does all that happen? What matters is our own behavior. So when it comes to assets where you cannot put a neat formula, behavior comes into play or psychology comes into play. Let us for a moment step back and figure out, why does the formula not work? Why does A equal to P into 1 plus R raised to N not work for equity investing or for real estate? The reason is these are long dated assets. So equity is ownership of a business, and to value that equity share, you have to estimate the profits next year, the year after that, to eternity. Now that profit is a variable number. It does not, you cannot say with certainty what is going to be the profit 1 year from now or 2 years from now. Now if oil price suddenly shoots up, people become pessimistic. People think that this company will continue to make losses for all the time. And if for some reason oil prices are low, if profits are high, if occupancy is high, people think that this is the best business to be in. So people fluctuate on both sides. People either become too optimistic or too pessimistic, and that's where the psychology aspect comes into play, and that's where psychology plays a role in investing. When it comes to equity investing, a common error people make is what the well-renowned fund manager Peter Lynch called get evenitis, or to put it in Hindi, badla lena from the investment that you have made. If you have invested in something at rupees 100 and a share, and that share price falls to 50, you say somehow or the other I'll get even with this company or get even with this stock. I'll buy at 50 so that my average price comes down to 75, and when it goes back to 75, I'll sell it off. If it falls to 25, you will buy more. You will buy double the quantity probably, try to average down your cost price to 50. So rather than, and I'm not saying this is necessarily a wrong thing. If the company is attractive, if the business prospects are good, maybe it's a smart thing to do. But sometimes it's purely out of ego, or it's purely out of the fact that you are losing money and you don't want to recognize that loss, that you go on buying something and leave aside shares, investment, everything. It could be even in your day-to-day life. Let us say you have bought a second-hand car. The mechanic that you took to inspect the car assured you that it was in a good condition. But in 2 or 3 months, you realized there's a clutch problem, or there's an engine problem, or there's some other issue. Because you have paid hard-earned money for purchasing the car, you will get it repaired at a huge cost. After 2 months, again something will go wrong, but you will keep on putting money to justify your original purchase, or to say that I did not make a mistake originally when buying the car, rather than just getting rid of it. So this is one repeated mistake that we are prone to making. The other thing is, if some price you have seen in the past, it's very difficult to take away that price from your mind. If you have bought something at 100, the price temporarily shoots up to 1000 and then falls to 600. You may be making a lot of profit on your original purchase price. You may be needing money. You may think that 600 is an excessive price, but still you will not be able to sell it because you have seen a price of 1000. Or if you own a apartment or an office block, a deal happens in the neighboring apartment or for the neighboring office block at a particular price. That may be an irrational price, or that may be due to specific circumstances. Let us say someone was getting an adjoining flat or adjoining office and they were desperate to buy it. They paid a very high price which did not make any sense. But still, when it comes to your own sale, you will get anchored to that price, or in your mind that price will play a role and you will not be able to deal even at a fair price. This is again a pattern that repeatedly happens. Loss aversion, very similar to the first example that I gave. It's till the time you sell it, you feel that you have not made a loss, even though all indicators may be telling you that your purchase price was X and now it is half X. But still, you will irrationally hope that the price comes back to X and you will be able to exit from your original mistake. Let us say you are going to buy a property. Typically, you will value it less when you are a buyer versus when you are a seller for the same property. So this is an example I have seen last month itself in my own residential building in Mumbai. There's a flat owner in my building who wanted a bigger house. That person had a 1000 square feet apartment and was looking at a 2000 square feet apartment because his children got married and a larger family and whatever the reason. Now he had two options. He can sell his current apartment, which is 1000 square feet, and move to another building and buy a 2000 square feet apartment. That is choice one. Or he can buy a flat in the same building, 1000 square feet more, so total he has 2000 square feet. Now the guy, if he wanted to buy, he was quoting a price of 3 crores, and if he wanted to sell, he was quoting a price of 4 crores. Now, obviously that is illogical. The right price will be somewhere in between. So when we are wanting to buy something, we think the price is much lower, but the moment it comes to our own something that we already own, we tend to overvalue it. So if you are thinking about buying, let's say, shares of HDFC Bank, then you will mentally think, I'll buy this company when it comes to 1,500 rupees. On the other hand, if you are already owning it, you'll say, no, it's a great bank, great management, good track record. I'll sell it only if it is 3,000. So many a times the decisions that we have already made, we tend to not execute on those because we tend to put a low price if we don't own it, and we tend to put a very high price if we already own it. This is a great example of why the share price of Interglobe Aviation or Indigo behaved the way it did. When crude oil price touches 80, 85, when rupee dollar rate goes to 74, 75, 76, we think that crude oil price will keep on going up and that rupee will go on depreciating, and because of that we think all airlines are doomed. And on the other hand, when rupee appreciates, when crude prices are under control, we think aviation is in great shape and that's a great business. So we are driven by the events which have happened today and the last 1 week, 10 days, and we tend to forget longer term history. So this causes a lot of mistakes in our investing behavior. So this is what I wanted to illustrate and create the awareness of all the mistakes that we make in our investment journey, And the first step towards avoiding any mistake is to be aware of the mistakes that we are making, so that this is a small attempt towards that. And we'll obviously interact, and I'll be happy to take questions later on. So this is what I wanted to talk about today. Thank you very much.